Assalamu-Alikum and welcome back. So our today topic is exchange rates and their measurements. An exchange rate is a relative price of one currency expressed in terms of another currency or group of currencies. For economies like Australia that actively engage in international trade, the exchange rate is an important economic variable. Changes in it affect economic activity, inflation, and the nation's balance of payment. Looking at the Australian dollar, that when it convert to the US dollar, exchange rate give you the amount of US dollar that you will receive for each Australian dollar that you convert. For example, if you have to convert the Australian dollar into the US dollar, you have to convert the Australian dollar into divide the Australian dollar to the US dollar. Rate of both the currencies. Let's take an example. If you have to convert 0.75 0.75 and convert it to the 0.75 dollar and you want to convert it to the US, so you will get 75 US dollar for every Australian dollar. For every one Australian dollar you will get 75 US dollar, and this is the conversion of the US dollar. So the bilateral exchange rate are visible in our daily lives and widely reported in the media, like consumer are expressed to them when they travel overseas or when they order goods and services from other countries. Businesses are exposed to them when they purchase inputs to production from other countries and enter contract to export their goods and services elsewhere. So Australian dollar is the sixth most traded currency in the foreign exchange market. There are different ways in which exchange rates are measured, and over the year there have been different operational arrangements for determining the value of the Australian exchange rates. Now there are measures of exchange rate. Number one is the bilateral exchange rate. So there are many ways to measure the exchange rate. The most common way to measure a bilateral exchange rate. A bilateral exchange rate refers to the value of one currency relative to another. Bilateral exchange rates are typically quoted against the US dollar as it is the most traded currency globally. So the second one is the cross rates. So bilateral exchange rate also provided a basis for calculating cross rate. A cross rate is an exchange rate calculated by reference to a third currency. For instance, if the exchange rate for the euro against the US dollar is known as well as for the Australian dollar against the US dollar, the exchange rate between the euro and the Australian dollar, like euro divided by Australian dollar, can be calculated by using the formula like AUD, which is the Australian dollar, and USD, which is the US dollar, and euro divided by the US dollar, that is the euro divided by AUD, which is the Australian dollar, and it is equals to the euro divided by US dollar into US dollar divided by Australian dollar. So this is the basic concept of the conversion. Now we will discuss the trade weighted index. What is trade weighted index? While bilateral exchange rates are the most frequently quoted exchange rate and are most likely to be quoted in the press, a trade weighted index provides a broader measure of general trends in a currency. This is because trade weighted index capture the price of a domestic currency in terms of the weighted average of a group of or basket of currencies rather than a single foreign currency. So the weighted of each currency in the basket are generally based on the share of traded contracted with each of the country's trading partner, usually total trade share, but import or export share can also be used. So as a result, a trade weighted index can measure whether a currency is appreciated or depreciating on average relative to its trading partner. A trade-weighted index generally fluctuate less than bilateral exchange rate because movement in the bilateral exchange rate used to construct a trade-weighted index will often partially offset each other. So this is the very basic concepts of the measures of the exchange rates.